Hello and welcome to the download. I'm your host, Dave Richardson, and it is Tuesdays, and it's a pretty special Tuesdays, isn't it, Stu? Why is it such a special Tuesday, Stu?
Because it's video, Dave?
That's
Or
right. Look at you. Oh, you look sharp, Stu, with your plant and your wall. We kind of faked out the listeners, and I guess more the watchers, but I guess the listeners too, when we thought we were going to be going live with video a couple of months ago, and we had to work through some I don't know what we call them, legal hurdles would be maybe the best way to describe them to allow for video, but we've got that. We've also had full makeover since that time, so that's why Stu looks so good. My makeover didn't work as well,
I,
right,
I,
Stu?
I we might need to get makeup and things like this, like a facility here, to prepare for these things.
I know. What does your wife like your new look? I want to. I think the ultimate goal here is to get you back on the subway and doing a video live from the subway, because we
Yeah,
should be able to make that work at some point once we really get going with this.
yeah, we could do live from the subway. That'd be pretty cool with video.
Live, actually, like both of us could be sitting side by side on the subway.
Yeah, we could be like Willie
And
Nylander taking the subway, and not that we're as
well,
popular as him, but
yeah, no, we're not as popular as him.
no.
Although we show up in the playoffs. I guess that's more Mitch Marner, but we won't get into Toronto hockey. That'll bore the rest of the country. We are excited about the Edmonton Oilers in the Stanley Cup Finals for the 4 games they're going to get to play. But
It's gonna be more than four, Dave. Got think we're believers here.
we're believers. That's right. We're believers. Actually, you know what they need? They need an in his prime Jean Beliveau, like the jersey you've got behind you. That could turn the series. But let's talk about, since people actually come in to A, not look at us, and
Yep.
B, not listen to us talk about hockey. Let's move to what's turning markets today and rally again to all-time highs, as an inflation report out in the U.S. this morning shows inflation coming in a little bit lower than expected. And I know you've got lots of comments on that. And then just as we're about to tape this, the Federal Reserve's out with their announcement this month for rates, and they leave rates unchanged. When you look at the dot plots and the different ways that they can sort of telegraph what they're going to be doing later on through the year, it looks like they only think they're going to cut rates one time this year. Of course, we had last week the Bank of Canada cut interest rates. So Stu, let's start with inflation, because I know we've talked about this on some recent podcasts, just in terms of how an announcement moves markets, and how an announcement with, that's a tiny little bit different from what might have been expected moves markets. The Nasdaq is up 300, it's up almost 2% today with that announcement this morning.
Yeah. So you're always looking at the kind of general direction of things relative to the path that you thought was in place, and I think markets are kind of in this phase where they're, like, it's an old proverb, but it's like crossing the river while touching all the stones. So you're kind of taking it, you have an idea about where the end game is headed, but you're taking each news, very significantly in a short period of time. So within the last, even within the last week, we've had some better inflation data. We've had some interest rate cuts. Then we had very strong payroll data. Then we had some better inflation data. Then we have the Fed, and it kind of creates this gyration around a longer term or an intermediate term view that the economy is kind of slowing, inflation is heading in the right direction. So and you're commenting on any given day. But generally speaking, those directions are heading our way. And we had one inflation print where if you looked at second decimal, it wasn't so bad, but people rounded up and it caused consternation. And then today you get a little bit better. Although I would say when you get underneath the hood and you look at the components, it's all, it all does look a little bit better. I think you hear a lot of commentary around, like, if the Fed is forward looking, then they might say we're going to be a little bit more generous on interest rate cuts because we know, or we have a feeling that things are slowing. Versus if we're very data dependent, we're going to maybe not move as much in interest rates because we're going to want to see things, right? And of course, waiting to see something then lends to the criticism that you're going to be behind the curve. So it's just a rambunctious amount of commentary on both sides. And when we kind of peel back what's going on, it's the economy is softening a little bit at the margin, and inflation is heading in the right direction.
Yeah, and kind of continues this trend that we've been talking about the last few weeks of sort of, January to March data as it's released comes out a little bit stronger than we may have thought coming into the year. And then April and May have largely been on the softer side. And that did open the door to the Bank of Canada. We're not going to let that slide. We'll get back to that in a second. I mean, even the employment report, we had Eric Lascelles on Friday. I mean, if you dig deep enough in that employment report, there's some softness even in that. It's a big number, big headline number, which grabs the attention. But when you dig into it, a lot of government, a lot of part-time, and the unemployment rate still ticked up. So just a continued theme of and you walked through it. I think it's 3 episodes ago. If you go back, it's 3 or 4 episodes ago. Just around this idea that we've got markets moving on some very small shifts in differences in the data, rounding up, rounding down, and that when you start to look at economic indicators, that we have started to see those surprises come in more on the negative side than positive side, which leads you to believe that we may be getting that last final death blow being dealt to inflation in the system.
Yeah, I think that's bang on. That's where you get into the average stock, the average consumer that maybe has some debt and things like this. They've faced some challenges, and they could probably benefit from lower interest rates. The bigger companies and wealthier consumers, they might be the reverse. They might be actually benefiting from higher interest rates because they have savings, they have cash on the balance sheet, and they are part of some of the it's just a handful of them, but they're part of this artificial intelligence theme, which is quite robust. We've seen Nvidia has been quite strong around their earnings numbers. Apple most recently was quite strong. Oracle today on the back of some big, what they call RPO, revenue performance obligations in their cloud business, which is kind of like a backlog of future revenue. So the artificial intelligence team has been very, very strong. It's drawn a lot of capital to it. The question is it, does it have the stamina over time to justify some of the very high valuations? And we go through that company by company, and some it probably does, and others we're a little bit wary, and that's something that you have to kind of negotiate through a portfolio over time, and that just is what it is.
Yeah, and we were just talking before we came on, and if anything, as again we get to a point where we don't know exactly how much rates are coming down, we don't know exactly when rates are coming down, but as we've been talking about, it's getting clearer and clearer, and even in some countries it's already happened. Rates have come down, rates have been lowered, that ultimately in the States the next direction is that rates are coming down, not going up. So you would almost think, as again longer term interest rates have softened a little bit from where they peaked for this year a couple of months ago, so you'd almost think that you'd see a broadening in the market, but as you say, it's almost narrowed, right? It's just this one area is sucking up all the interest and all the demand from investors.
Yeah, I think the biggest area of weakness in, say, the last month has been in some of the big software companies. And, so there's all sorts of decisions that, I like, consumers make them all the time. Businesses make similar decisions where, the economy, maybe the amount of money in your pocket starts to shrink a little bit. And, it's just it shrinks and then it stays there for some period of time, and then the decisions you're making right before your pocket might fill up again, they're the ones that you delay the longest. But then you're forced to kind of make a harder decision, and we've definitely seen in some of the software areas where companies are saying whether or not they're feeling a bit of a slowdown, or just the drinking from the fire hose of what to do on the artificial intelligence front. It's almost like a paralysis by analysis, or whatever the word is. So there's been a delay in some revenue in some companies. So even as the market had narrowed around technology, even within technology, it has narrowed that much further to just some semiconductor names and a handful of big companies. As I say, like every company, when you pay a high valuation for something, it doesn't mean it won't be a successful stock, but it means that the range of outcomes begins to narrow. You need more and more good news to kind of drive that success. And we're seeing elsewhere in other sectors where there were very successful companies, and some of them have halved because the valuation. There's nothing wrong with the clothes they produce or the businesses that they conduct, but the growth slows a little bit at the margin, and the valuation changes dramatically. So that's the type of dynamic that we're left to kind of work our way through. And when you see large price gain, that's telling you one of two things. It's either pulled forward return, or the new hurdle for earnings growth needs to be that much higher. And we need to look at valuation on a number of measures, like price to sales, price to earnings, how much margin do they have, how could those margins change, and that's what you begin to worry about when the market narrows, because there's a couple of sensitivities that could go the other way and cause a bit of a price change, versus this kind of broad swath of stocks that are waiting for the economy to reaccelerate a little bit, and their valuations are at levels where they could be stable, maybe even improve, and you'll get the benefit of earnings growth when those come through.
So you were somewhat nervous, or you expressed some concerns about the narrowness of the market, and have over a good chunk of the last 12 months, really. As it narrows even further, does that create even more concern for you? Does it look like anything where we've seen similar situations like this in the past, say like the late 1990s? Does it start to look and feel like that to you?
It's very stock specific. Like, I don't think you can make a comment about all of the Magnificent 10 or all of the Magnificent 7, whatever the number of stocks that you want to look at. Like in each case, you're assuming that the company's growth profile will go back to some type of average, right? Like if the S&P 500's earnings pool grows at 7% over long periods of time, there has not been very many companies that grow at even 20% for 10 years, let alone from now till Kingdom Come or anything like that. So when we look at all these companies, when you have a high multiple, you're banking on earnings growth for a very long period of time, and that's what we have to kind of think through here. So versus this kind of broad swath of companies which have not performed as well lately, the range of outcomes that sit in front of us that can make those successful stocks over the intermediate term, they're more in our favor. So it's a bit of a waiting game. There's portfolio construction. It's very dependent on the type of fund that people have signed up for. Value and dividend oriented funds have been collecting cash flows and maybe not participating to the same degree in some of the AI themes, versus even some of the big growth funds have to sit there and say, boy, like, we're getting a ton of revenue growth, but how long does that persist for? And is the market maybe a little bit over its skis on some of those things?
Do you feel more comfortable managing several $1 billion in a market like this, or do you prefer it to be a broader market? And is this a more challenging market to manage around? Is there a case where again, when you've got a small number of stocks leading higher, you're not going to be as overweight in those stocks as the index might be? Does that make it harder to keep up with an index in an environment like this, so that ultimately you're proven right, but in the near term, you're going to be you're going to look a little bit like you're falling behind. How do you feel about a market like this as a professional investment manager?
Well, I feel like when I look at a bunch of the companies that we own, I feel like we have, pretty good intermediate returns embedded in a lot of those companies. When I look at the daily performance relative to the index during, periods of time like this, there's some funds that, depending on style, have tracked, just fine. There's others that begin to lag behind, but um, it's very important that what's inside the funds, does what's advertised, and feel really comfortable that that's the position we're in across all of our different mandates. So, you may have some, dividend oriented funds or some value oriented funds where you're saying, well, I'm not participating at quite the pace that the broader market, but you're sitting there saying, yeah, but I own a bunch of businesses that are going to compound at, high single digits to double digits, and that's in my financial plan, and I don't feel like I'm taking, quite as much risk, perhaps as some, like from an investment process standpoint, there's a line like I'm high up on the ladder picking fruit from the top of the tree. There's a couple of sources of risk there, right? I'm high up on the ladder, which means my valuation is high, and there's not as much, the likelihood of really good fruit at the top's not as good either. So, so we just have to be a little bit careful when it comes to those some positions. Maybe tighten up, some of the other tools in our toolbox that we use technically and things like this, around how that momentum might shift. And it's so it's definitely a little more challenging. Like, of course, everyone wants the stock market to agree with you entirely the moment after you finish purchasing the stock. We all want that for sure, but that's just not the environment we're in.
Yeah, and then there's the whole and what I was getting at for again, for you as a professional investor, you've created a structure, a process that you follow that keeps you from getting involved with the emotion that can sometimes come out of a market like this, which my kids would use the term FOMO, or fear of missing out, right? That, hey, my neighbor owns this stock. Wow, he's making all kinds of money. She's doing really well, and I'm sitting here. I think I've got a good portfolio, but boy, I really wish I had more of that. And we see, I've been in this business for over 30 years, and you just see people, friends, family too, as they talk to me, and as I'm out talking to investors, they just, wow, I feel like I should be in that. I got to get in. I'm missing something. And that's always dangerous, isn't it?
It can be like it when you're in a more of a momentum driven market, you're dealing with a different toolkit for success in that area. Um, like when you take some companies and within 25 or 30 days, they're going up like the valuation of a Berkshire Hathaway. And you're kind of like, wow, that's been pretty successful. And that took like, 30 or 40 years. And we did that in 30 days. It does make you, have one of those kind of, I'm not sure about that. It doesn't mean the stock's going to stop going down tomorrow. But it's like you say, when you're following an investment process, and you're saying like I need to own stocks that make sense to me, and we've got this investment process, and the stocks that we own, kind of make sense in that investment process. That's the way that you put your head on the pillow at night and say, yeah, it's all good. I might deviate one way or the other in a short period of time, but I feel like I've collected a bunch of really interesting options for the portfolio over time.
But I really like the way you position it as the fruit on the tree and going up the ladder. So right now, if I'm going up to buy one, if I have a fear of missing out, right, and I can see there's fruit on the top of that tree, but I've got to go farther up the ladder, and I've got to be comfortable with that, and I've also got to be comfortable with the idea that maybe, just maybe, something happens and the ladder blows over. And there can be some real pain when that happens. I know I've experienced this, Stu. I don't know if you've ever fallen off a ladder. It's not good.
Yeah, no, I have. I was a window washer in university, and
that's right.
When you fall off from the second floor, it's not fun. But yeah, like we were talking before about, Roger Federer came out and gave a,
Yeah.
and I think the thing about investing and investment process is it's a long game, right? And you're constantly trying to tilt the odds in your favor, but it doesn't take much. And Roger Federer made the comment that he won 80% of his matches and he won 54% of the points. And you could delve into those statistics, and when it's on his first serve, it needs to be this, and second serve, and what have you. But the notion is that when you have a stock in your process and the stars align, you need to make sure you're there. And if something doesn't align in your process, there might be a period of time where you use a different toolkit from a risk management standpoint, but eventually you just have to let some ship sail and say bon voyage, good luck, to the other people that might be invested.
Well, and the other lesson from that Roger Federer, it was a commencement speech that he was doing, and I saw it too. And the 80% and 54%, just the whole idea that the very greatest, actually end up winning by a very narrow margin. But when they lose, what's different between the real winners versus those that struggle is that they can shake off that lost point because they understand that it is a longer game. It's about winning the match, not every single point. And they're able to mentally get back into the game and win the points that are critical to win the match. And from an investment perspective, I think the closest thing I see with investors, and we've seen it a lot over the last couple of years, is you have a tough market, your portfolio goes down some, and then you run it instead of saying, hey, okay, what happened here? How do I need to readjust? Where do I position to win in the future? I just run away and I go to cash, and I sit in cash for a couple of years until I feel more comfortable, and that's when I go back in. And I think that's one of the fundamental differences between a professional investor, which is really one of the things we are trying to get at, is we're trying to get inside your head, Stu, and learn the mentality of a professional investor, just like I'd love to understand the mentality of the greatest tennis player of all time, understanding Roger Federer. What makes the difference? Because you're all faced with the same challenges. You don't win every point, but you ultimately win over time. And what is the mentality that creates that success? Because if we have that, we're ultimately going to get to where we want to go.
Yeah, no, it's bang on, really. Like, it's like saying it's a roadmap. Like, if this happens, this is what I'll do. If this happens, this is what I'll do. I'll know in advance. So, if news changes and that's bad, like if I own the stock for these 5 reasons and one of those reasons is not true anymore, then you have to be honest with yourself. If I own it for momentum purposes and the momentum stops as we would measure momentum, then I have to be honest with myself. If I don't like this stock and it starts getting better, I have to be honest with myself. So, the biggest kind of component that unlocks that is this notion of understanding the bull case and the bear case at the same time. Treading between the two, like being open-minded that as I buy a stock, the person who sold it to me believes the exact opposite, right? So why is that? And what could that mean? And what makes me right and them wrong? And understanding how that could develop over time. These become really crucial components to long-term investment success.
Well, that's great. And so again, we've been mostly on audio, trying to get into your head. Now people actually have a picture of what it would kind of take to climb into your giant head on the screen that we can see. You're filling up a lot of space with the angle. We may need to get the producer Nancy to take the camera back a few inches on you.
Yeah, well, I'm a rookie, Dave. So.
Oh, we're both rookies. I'm glad so many people are putting up with us. And again, I really like some of a couple of the lessons from today. Just again, they really they really do get into the mindset that you need to be in to be successful as an investor. As all of this news flashes across the screen every day, and how do you react to it? How do you manage through that? How do you keep your focus? So I learned a few things today, Stu.
Great. Well, that's as good as it gets, Dave. So So thanks very much.
And I think a lot of people learned that maybe audio is better. Looking at me. I just hope my wife never comes to that decision.
Okay, thanks very much.
Okay,
Dave.
Stu. We'll check in with you next week. Thanks a lot.
This recording has been provided by RBC Global Asset Management, Inc. for informational purposes only and is not intended to be investment or financial advice. You should consult your own legal, accounting, tax, investment, or financial planning advisors before engaging in any transactions.